So we would always look at, are the systems in place fit for purpose first? So what is the system? What is it doing, and how are people using it? If those three things aren't in place properly, then there's a risk that we should sort out. And we always look for quick wins first. So you want the quick wins. So it doesn't necessarily mean you have to go and spend thousands and thousands on a new system. It could be you have short-term, simple implementations that can give you good oversight and make sure things are working properly. It doesn't mean there isn't a need for a longer-term system, because it might be the short-term fix is a bit manual or not that efficient, or there is still some risk in that process, but sometimes it's risk versus reward. So you have to balance, well, what's the cost to implement an all singing, all dancing versus what's the risk of implementing a quick win in the short term until you can get to that longer term project. Welcome back to the Build and Exit podcast. This podcast is for founders and business leaders that are navigating growth, acquisition, financial clarity, and exit readiness. I'm Julie Wilkinson, and in each episode, we're going to explore operational, financial, and structural issues that are quietly shaping business value, confidence, and decision making. One of the most common things I hear founders say is nothing's actually broken, but everything feels harder than it used to. So that is, decisions are taking longer than they want. Teams are needing more oversight than they think they should. And the same issues just keep resurfacing. Something that I've been seeing consistently with the clients we've been working with is, on paper, everything looks healthy. Revenue is still growing. Teams are expanding and activity is high. But underneath it all, confidence is starting to shift. So leaders are double checking numbers. Decisions are taking a lot longer than they want. And ultimately, cash and profit just never seem to close where they expect it. And the underlying systems just don't seem to report the numbers that they expect it to. What I'm going to go through today is 3 key areas where we see this happen, and then what we recommend businesses to do and how to overcome the challenges. So if we look at why are leaders losing trust in numbers, what we typically see is that processes are in place, businesses are technically running well, but something underneath is making systems not report the correct information, and that's in the end resulting in lower cash and lower profit, and ultimately making it harder for business leaders to make decisions. So key areas we see is in the sales process. Now, the sales process, most businesses have CRMs in place, they have clients, really active, healthy pipeline revenue, and great customer base with great expansion opportunities. However, things are happening within processes that are making the process complex and ultimately putting risk to that growth strategy, which ends up resulting in things like money not coming in when it's expected to, or customers not paying, or projects not finishing on time. The types of things we see is where project systems are possibly not updated. So, for example, a project happens, the project's completed, but nobody updates the project management system. So nobody then gets told that the invoice needs to be raised, and that customer is not invoiced. Sometimes it's not invoiced for the right amount. Other times it might be completely omitted. But either way, there is a discrepancy of what that customer should be billed. And where we see a high dependency on individuals, so some people know it as owner-operator, or it could be managing directors or key individuals that are having to put high dependency on their knowledge, is when people are having to find these issues because of their knowledge rather than it working through the system. So that would go for things like the owner goes on every Friday just to double check that all the projects were closed properly and the invoices were raised. It would be managing directors or sales directors are having to constantly check, are all these invoices right and do they match what we originally quoted, because it's not trusted that the system would pick up the information. And it would go for things like additional reports and manual overriding of systems where people have to then keep like separate Excel spreadsheets saying these are my projects because they don't trust that the system reports the right numbers. So all of these types of things are what we would call manual overrides. They're either loss of trust in systems where people are manually overriding information, key dependency on certain individuals that are going in and checking, has it been done right? Because previously it's not and they can't trust that it will be done right. And constant process overview. So maybe additional meetings than needed or rework because something doesn't always work first time. And the output of this is ultimately customers not being billed, cash flow not coming in, and profits being underutilized, because the output of these inaccurate systems is that ultimately less cash in bank, less profit, because things aren't happening as they're meant to be happening. So that's sales. So that's the key area in sales where we see, and this often happens because there is a disconnect between what we call front end systems, usually the CRM or the project management system, and back end systems that we call finance systems. So finance systems are typically what link to things like your bank account, because they are transactional led. They are money comes in and you transact those invoices and banking. Whereas CRM and project management systems are front-end systems that are usually managing customer relationships and projects. The question then is, do those two link together, and do people know how to interpret that information so things happen correctly? And that's where we see the gap and the lack of inconsistencies. We found recently, where we've done investigations for clients, we found hundreds of thousands of pounds not invoiced, or invoiced materially incorrectly due to these inconsistencies, because one, it's happening, two, there's no system in place to actually check the integrity, and three, there's no then month end and financial reconciliations to catch it. The next area of business that we see this happening in is purchases. So this would be, we call it purchase to pay. So purchase to pay is everything from order, when you put an order in with a supplier for goods or services, all the way through to payment. Now that end process seems quite simple. We place an order, the supplier sends an invoice and you pay it. But actually, there's a lot of things that go on in that process that can fundamentally make impact cash flow or risk the business actually paying incorrectly. So when we test purchasing processes, we look at how well do systems link. Key areas that we find have discrepancies are where purchase orders are bypassed. So that means it's normal for invoices to come in with no purchase order. And because it becomes normal, it means that things are often bypassed in terms of payment runs. And that would be things like the managing directors or the owners or whoever the sort of main leader is that signs off invoices goes, oh, that's okay, let's just let it go through this time. Or that's just quite normal, I'm just going to pay it. That then often comes down to dependency less on individuals, because what's often happened is these people are sometimes getting statements from suppliers, and because it becomes the norm and something might happen like the account goes on stop, they just make the payment, and then actually no one checks, have they paid it twice? Is it actually due? Is it the right amount? And that's because fundamentally from the order stage, the process wasn't followed. And we've recently done some investigations into this type of purchasing. We test processes. So we look at businesses' infrastructure and we look at, okay, so how well does this process work? And recent investigations saw we found nearly 500,000 overpaid or duplicate paid because of these no PO processes. And this was a mix of invoices being paid twice and invoices being overpaid because they didn't have the financial processes that would cross-reference that this wouldn't happen. And not only that, they then didn't have the processes in place to keep track of it or do a second check at the end to make sure payments were correct. So when we look at financial processes and risk, we look at, what are the systems? Do the processes work with those systems? But not just that, is there then a check process at the end that can catch if anything does go wrong? Because this isn't about everyone being 100% correct all the time. It's not about people can never make mistakes, but it is about, well, if someone does make a mistake, how big could that mistake be and who would catch it if it happened? And would material mistakes that could massively impact the business, are they eroded? So we look at what's high risk, how do we mitigate that? And then what's lower risk, but also if it is lower risk, it's not that you want it to happen, but perhaps you have less stringent process, but actually you have checks at the back end. And this is where there's a gap often between systems and financial processes, because the systems are there, the people are there, theoretically the process is there because people should be following it, but actually people don't follow it, and then there are no checks or financial processes to pick that up at the back end. So that's the purchasing process. And the final thing we see, which is generally the output of the sales and the purchasing, is the cash flow. So most people have sort of 12 or 16 week cash flows that they're running regularly. They have inputs and outputs, so they have money coming in, money going out. But then what we tend to find happens is cash just doesn't land as is expected. The business is busy, people are busy. There's meant to be a check, but the check never happens. And by the time you know it, you're on to the next week, and then the same thing happens. So we would call this, there's a forecast, but do we actualize the forecast? So forecasts are great because these are our planned activities, and you obviously make decisions of forecasts. But actually, in reality, if these forecasts never come off, the next step is, well, why don't they come off? And this then comes back to the processes, and obviously sales and purchases, ultimately money in, money out, is what ends up making the bank balance, because it's either you're spending or you're getting money in. Obviously the accounting treatment of that is more complex, but in terms of money coming in and out. So if the cash doesn't end up where it's expected, usually it's one of sort of three things that have happened. Payments were made when they wasn't expected to, and cash didn't come in when they were expected to, or things came out, urgent things happened in processes to make those things move. And then is how material are those numbers, and what's the impact to the business in the short term? Because we have identified, actually, sometimes we're seeing swings of movements way over $500,000, which is obviously making big short-term cash implications for businesses, especially if it's happening towards end of month, and then they've got their fixed overheads like payroll and things like that to meet. So it's not to say that cash flow is never volatile, but it's what it's asking is, well, how volatile should it be? And should we be able to spot check this through our systems? So the processes should be there. The cash should come in, but actually if the processes aren't being followed and nobody's checking that process and then actualizing against the forecasts, then it all gets missed. So what do we recommend to businesses who have these challenges, and how do you overcome them? Well, it goes in three stages really. We look at, is the system fit for purpose? Are the processes aligned to the system, and do people know that they're in place? Because this isn't always necessarily people don't follow them. Sometimes people don't know about them. And then we look at, is there a good integrity process? And that's more financial processes to support those operational processes to then catch if things go wrong. Those processes will be dependent on the system. Some people have more advanced system than others. But in theory, it doesn't actually matter if it's an Excel check or a fully automated system check. The question is, can you check it? Because actually we find a lot of people are bringing in systems really quickly, thinking the system will just solve everything, when actually the output of the system is only ever as good as the input. So to go and move forward with a system quickly when you have no real insight into what's going wrong can actually make it worse, because there's more trust in the system. Oh, the system should just work. But actually the system doesn't always work if the inputs into those systems don't work in the first place. So we would always look at, are the systems in place fit for purpose first? So what is the system? What is it doing, and how are people using it? If those three things aren't in place properly, then there's a risk that, we should sort out. And we always look for quick wins first. So you want the quick wins. So it doesn't necessarily mean you have to go and spend thousands and thousands on a new system. It could be you have short-term, simple implementations that can give you good oversight and make sure things are working properly. It doesn't mean there isn't a need for a longer-term system, because it might be the short-term fix is a bit manual or not that efficient, or there is still some risk in that process, but sometimes it's risk versus reward. So you have to balance, well, what's the cost to implement an all singing, all dancing versus what's the risk of implementing a quick win in the short term until you can get to that longer term project. And so it all kind of depends on what the findings are, what the problems are, and what systems need to be in place. Most industries are similar, but obviously depending on the materiality and the risk factors in the industry, it could change perhaps the focus of what you put in place. But in principle, the process is similar for all industries. It's just, where's the biggest risk? What's the biggest dependency on one person? Where do systems fall down? And then ultimately, how do you put processes in place to stop that? So when we do the assessment, so as a recap, the assessment will assess the systems, the process, and then also the integrity of where are you checking if things go wrong. Now that often comes into what we call integrity reports. So integrity reports are things that are built that capture where it just shows the errors rather than necessarily the whole process. So that might be things like, so at the minute you have a report and perhaps it shows all the invoices raised, but all the invoices raised might be a 100-page report. And the truth is, it's very difficult for someone to really look at that 100-page report because there's so much detail on that report that actually key things to get missed. An integrity report would be, well, let's change that report. So actually only the things come off if it looks like there could be an error, and then we would call that an integrity error report. And an error report would then show you, rather than showing you every single thing that went on, even if it was right, it would say, well, these are the 5 things that went wrong. And then what it does is it highlights that, makes it really visible so that people know where to focus their attention rather than looking at everything. And that's the integrity side of the processes. The question then is, are the systems built to give you those reports? So that's where you need the system, the process, but also the people and the checks in place to make sure it works properly. So we do the assessment. Once the assessment's in place, you can then start to implement changes. Now this can come down to culture, it can come down to team performance, or it can come down to sort of broken systems where maybe operational teams aren't interlinking with other departments very well. So the implementation might come down to policies where you actually need to find policies for people to follow things. It might come down to processes are in place and teams need training because they're not following them. Or it could actually come down to systems aren't fit for purpose, and actually we do need to implement a new process or a new system that teams can follow. And the implementation is not a one-sided thing. There's a assessment, it needs to be reported, and all the people involved need to be, part of this project to make sure that everything works and that operational teams are coming together. And once the assessment has happened, so the assessment's happened, the implementation happens, and then we look at business as usual. Now, what we tend to find with businesses, and this is why we see that people go, nothing technically wrong, but it feels harder than it should, as I started with, it's because businesses develop. Businesses grow, and actually infrastructure needs to grow. And we tend to find that a lot of people grow sales, the pipeline grows, processes become more complex, but actually the system architecture is not changing. So therefore, what might have been fit for purpose 2 years ago might not be fit for purpose anymore. So this isn't always just we put it in place and now that system works. It could be it needs a assessment of that system and that process on an ongoing basis, whatever that time frame might be, to make sure it's still fit for purpose. Because when systems get busier or they become more complex or more people become involved, it might be what worked when there's only 1 or 2 people involved may no longer work when there's 15 or 20 people involved. And obviously that then can change as the complexity grows. So the business as usual becomes, this is the system, it's running and everything's in place. But then it's, when do we need to do the next assessment to make sure that the systems are keeping up with the growth of the business? And after all those 3 things, the assessment, the implementation, and then the ongoing business as usual, we find that owner dependency is reduced because there's processes and integrity checks in place to pick up errors, and it isn't reliant on somebody knowing what to look for or somebody's knowledge of the business. Cash flow and profits are a lot more predictable because the month-end processes and the finance processes are in place to do that. And also there's a lot more confidence because there's confidence in the systems, the processes work, and the numbers report as they're expected. The confidence builds up and it allows leaders to actually make quick decisions and take the business on the strategic direction that they want to go on. So the summary of this is, if you're finding as a leader that your profits aren't where you expect, cash flow never seems to stack up, or you find that things are dependent on certain individuals, that might be yourself as an owner or CEO, or it could be board members or key individuals in the business, is telling you there's perhaps a risk in your systems and processes that needs to be looked at, so that because the business may have outgrown the systems. One of the most important things that we see is nothing has to fail for a business to start struggling operationally. In many cases, actually, warnings show up much earlier, and it usually happens in friction. So friction between teams where information isn't flowing, loss of clarity, slower decisions. So you can't make a 100k decision or a 200k decision. Is that because you lack confidence? And ultimately, there's always double checking and rework because there's a lack of confidence in what's actually coming out of the systems in the first place. And that's because finance can technically work, reports can seem to be right, but leadership still doesn't trust the numbers. So I hope you enjoyed the show. I'll be sharing more conversations and insights around growth, acquisitions, financial clarity, and exit readiness in future episodes on the Build and Exit. If you love the show, hit the subscribe button, share it so more people can find the channel, and I look forward to seeing you again soon.